everyone, it's tax time, and welcome to part one of our two-part series, special series on taxes. Today we have Sandy Schultz with us today from H&R Block as our special guest, and she's going to spend a few minutes telling us the important things we should watch out for as homeowners or potential homeowners on our tax returns and things we should take advantage of since we are coming up to that deadline just a mere, 5 weeks away, did you say?
5 weeks from today is the
5 weeks
deadline.
from today. Well, take it away, Sandy, and tell us what we need to know.
Thank you, Pam. First of all, when a person is looking at doing their tax return, they have to know if they're going to take a standard deduction or if they're going to itemize their deductions. You want to go whichever one is bigger. Now, if you're a single person, your standard deduction is $5,950. If you're married, your standard deduction is $11,900. Now, if you have more than the standard deduction in itemizable type things, you're going to want to itemize. The biggest itemizable type thing is home mortgage interest. Most people that own a home will be able to itemize their deductions because of this home mortgage interest and then also because of their property taxes. Now, sometimes people will take out a second loan, like a home equity loan, that is also a deductible home mortgage interest. You can even take out a mortgage loan for buying a boat or a camper or a trailer and write that off as mortgage interest as long as these items have facilities on board. In other words, running water, a bathroom with running water, etc. So if you have those things, those loans will also count then as home mortgage interest. Another thing that's interesting is when people go to buy a new home, very often you will pay points or a loan origination fee. Those points or loan origination fees are also deductible in the year that you buy your home. If you decide you want to refinance your home, which like right now a lot of people are doing that with interest rates being so much lower, you pay points or you pay a loan origination fee. At that time, you can't write those points off in full when you refinance, but what you do is you amortize that over the life of the loan. So in other words, if you refinance your home for a 10-year mortgage, that's 120 months of payments. The points or loan origination fee that you pay would get divided out by the 120 months of the loan. So you don't get it as quickly as you do when you buy a home for the first time, but at least you still get to use some part of those closing costs because the rest of the closing costs are not deductible.
So Sandy, in summary, what we need to do is check into itemized versus standard deductions, look at which parts of our closing costs would be deductible, and make sure we get the property tax deduction in there as well. Correct?
Correct.
Perfect. Well, thanks for sharing that with us.
Okay, thanks, Pam.
Stay tuned for part two.